Hi, this is Todd with Integrity Investment Advisors. Today's going to be a fun video on DFA versus Vanguard. Who is better, or should you use both? So I'm going to walk you through the data, and I think this will be very interesting and sometimes debated in the community out there. So let's start with the sad truth. Most financial advisors will end up doing more harm than good. The big banks and advisor firms, they want you to believe it's normal to just pay 1%. We don't believe that at all. So if you have a portfolio over $500,000 to $10 million, we believe you want somebody who's fee only, they're a fiduciary for you 100% of the time, and advisor fees below 1%. We also believe we want them to use both Vanguard, dimensional funds, Avantis, and some other great institutional players. So please watch this video. It is worth over $1,000 a minute, and we are really built for the Millionaire Next Door. So here's 5 things we think you want in an advisor. You can pause any of these slides, but we think you want somebody who's fee only, not fee based. You don't want fees and commissions. You want somebody who's a fiduciary for you 100% of the time, and you want advisor fees below 1%. So our advisor fees are 0.6% on the first million. They decline above $1 million. So we are super cost competitive for the scope of services we have. For somebody who's got $1 million is 0.6%, 2 million, the blended rate is 0.45. So that would be $9,000 a year, 3 million, $12,000 a year. So this is a massive value over a lot of other advisors out there. And most of the clients we work with really think they're going to need somewhere between, $1 and $2 or $3+ million to have the retirement they want. So we can really help you, and again, add massive value. We think you want a data-driven approach, and that's what we call looking at the stuff with the returns with dimensional funds, evidence-based investing, and you want great software. And then you want a holistic approach. Portfolio management is one part of it, asset allocation, but also financial planning, tax planning, Social Security planning. Roth conversions are a huge strategy that a lot of people miss. And then access to low cost, no commission, annuities if somebody needs that. So a couple other things here. If you were in this world over here on the left and using a broker dealer or insurance rep, that's about 80% of the people out there. We highly encourage you not to use this model. They're mostly sales reps, high fees, limited investments, a lot of times proprietary funds. They're not data driven. They don't have great software. They're not fiduciaries, and they really don't understand the whole dynamic of long-term investing with indexing or factor investing with dimensional funds. A lot of times in these portfolios, we see A, B, and C shares or privately held proprietary funds that are just super expensive. So if you have $1 million or more, you can do a lot better than investing with those types of people. We believe you want a top-tier advisor, somebody who's a fiduciary for you 100% of the time. Advisor fees below 1%. They're data-driven and very knowledgeable about asset classes and asset class mix. And not using just one family. We don't like to see advisors who just use one family, like, even Vanguard or dimensional funds or Wells Fargo funds would be over here. But you want the best of breed for different asset classes. So we believe you want direct access to dimensional funds, Avantis, AQR, iShares, Vanguard, and many others. And then you want great software and tax strategy on top of that. Your advisor, if you have one, should be helping you to live your best life possible. And that's what we do. All advisors are not the same, so you want an advisor that has these items here on the right, with great people and great software. So here's what we believe is important about investing and working with an advisor firm. You want the investment management, which we're going to cover here coming up, I promise. But you also want retirement planning, and then you want tax planning for Roth conversions also. So make sure you're getting this full scope of services. If you're paying 1% for just investment management, I think you're really overpaying. You don't have to pay 1%, for all of this. You can get it. That's what our model does. So jumping into asset allocation here, we believe that as you retire or get close to retirement, you should have a time frame of some safer assets here, sort of liability matched to your investment horizon. So probably 0 to 7 years worth of cash flow you need, so you don't have to sell stocks in a downturn. And then a large part of your portfolio should be in equities, long-term equities, really utilizing both beta and factors. So you want to know what you own and why you own it. And then there's a middle bucket here that has some hedging, maybe something like AQR or JP Morgan, some alternatives, once you've filled up these other buckets. So here's the history of investing and sort of why we believe the answer is you probably want both Vanguard and dimensional funds and funds like dimensional funds with Avantis and AQR. But it used to be the history of investing was really active returns. And then over the years, they've segmented it out. Alpha is sort of pure skill is what we call that. But over the years, they've segmented this out. So you have market beta, which would just be indexing, broad-based indexing, S&P 500 or Vanguard total stock market or a global market like VT is the ticker symbol for the ETF. But on top of this, you have other factors like value, growth, momentum, quality, dividends, low volatility type of stocks. And then there still is some skill out there. It's really hard to find. So when we walk people through this, we think you want to pyramid something like this. So you want a lot of beta in your portfolio. It's cheap. It's super tax efficient. S&P 500, global stocks via ETFs. All of these really for ETFs. ETFs are much more tax efficient in taxable accounts than mutual funds. But this is a cheap way to get access to the markets from that standpoint. Above this, you want to add factors, in our opinion, specifically high profit, quality, momentum, value, small cap, dividends, with high quality companies like dimensional funds, AQR, and Avantis. So this is super important to add enhanced returns over decades. And I'll show you a slide on that. You want macro bets in some cases like AI, technology, improvements, software, infrastructure. And then this top part of the pyramid is really for clients who have more than $1 million, sometimes more than $5 million. We would say what you want to add in this bucket is going to be strategies from something like AQR, maybe managed futures and trend, maybe some puts and calls, maybe direct indexing. We have direct access to all of this. We really do like AQR for some long, short investing and hedging, which you'll see a little bit later in this slide. But this is the very top of the pyramid. You want to make sure you have all of this other stuff built first. And this is really for assets, above a couple $1 million, I would think. So focus on these first, and that's where the data is most supportive. Here's a great slide we share with clients. Mostly long-term investing, S&P 500 beats cash or T-bills over rolling periods. You can pause any of these slides, but there's a tremendous data set here from dimensional funds. Value typically beats the S&P 500 81% of the time over 10-year periods. Small wins over 10-year periods 65% of the time. And our favorite strategy is high profitability and quality. Over rolling 10-year periods, it wins 94% of the time, according to dimensional funds, and it outperforms by over 1%, say 1.3%. So again, getting direct access to this through a qualified advisor can really be helpful for your portfolio and pay off over time. If you're using like a broker or Merrill Lynch, Wells Fargo, any of those people, Edward Jones, and they have you in active funds versus indexing as the core, you're really missing out. This is from the SPIVA scorecard, and indexing has proven itself way over active concentrated stock picking for most companies over long periods of time. So over a 10-year period, 95% of the mutual funds out there fail to beat the broad indexes. And it gets even worse over 15 and 20-year periods. So you want to make sure you're focusing on indexing and then indexing plus factors, okay? And then here's some great data. This is 1990 through the end of 2023, so it's like 34 years worth of data. You can see why we tilt towards owning equities, because bonds over that period 5%, but inflation at 2.7%, okay? And then here's the S&P 500. You can see some of the factor loading with dimensional funds has done quite better than that. So this would be adding value and some small cap and high profitability. High profitability is consistent track records. And the nice thing to point out here is actually omitting low profitability companies is a really good strategy in ETFs. And this is where some of the outperformance comes from, is not buying those as part of the ETF. And then you can see here how balanced strategies, normally somebody's going to want a long-term portfolio of at least 50-50, maybe 60-40, 70% in equities on how those returns have been over decades. But really, we think you want a safety bucket for shorter time horizons. You're going to need to embrace risk for long-term investing, match your money with your time frame. During bear markets, just keep buying. We want compounding over decades, net of all fees. and we are really built for the Millionaire Next Door. So let us know if we can help. You'll see we do offer free second opinions. Here's another slide. Again, the longer you hold equities, the higher your win rate. We did some analysis since 1975, 466 rolling periods, 85% of the time the returns were more than 7%. So again, you want to own equities for the long term. And here's a great slide that shows this. If you invested $1 million in the S&P 500 and $1 million in the ag bond 20 years ago, the ag bond grew to about $1.8 million. S&P 500 grew to $6.7 million, and inflation was right behind this at about $1.7 million. So barely beating inflation over a 20-year period, which is why we want to own some equities. And then here's another interesting slide. So this is VT, the global world index from Vanguard. And then we have bonds in here also. But I added in the dimensional funds, global equity. You can see it outperforms over the period. And then I also added in AQR, their long short institutional fund, outperformed over this period, added a lot of diversification because it is both long and short. And can be added to the portfolios if people choose to go in that direction. AQR is a great company also. Here's I'll link to this in my notes, but this is AQR paper that I really like. If you have a lot of money and you want to know how to structure it from an institutional standpoint, this has some really good ideas on how to manage money for the long term from that standpoint. But it's embracing risk, diversifying, bracing yourself for short-term volatility. Diversifying as much as you can, adding factors, adding alpha when you can find it, but being cognizant of taxes. Really good paper, and I'll link to it in the show notes. So if you want a second opinion, we offer that process. We can do a call. You can book a meeting on my calendar below in the show notes. But we basically do a discovery meeting. Most people who do this say they wish they knew about this, about their portfolio more in details 10 plus years ago. We do a discovery meeting. If that goes well, we will have you upload some information so we can gather some data. We will help you identify your red flags. We will schedule another meeting where I will share with you the results and actually give you a copy of the report, the fees, how much factor loading you have in the portfolio, what you can do to improve it, any red flags. And then you'll at least know one way or the other, you'll know what your portfolio is looking like and what you can do to improve it. If you see value in what we do, you can sleep on it and then potentially become a client. So book a meeting in the notes or from my website, and look forward to speaking with you. Thank you. Hope you enjoyed the video.